Jan, always good to see you. Good morning.
Very good to be with you. Hello.
You've written quite a bit lately about recession risk really not being so much of a 2022 story, if that's fair, versus 2023 perhaps and beyond. Does today's print sort of ratify that view?
I think it does. I mean, I would certainly agree with Brian Deese that we have a lot of momentum in the labor market. This was another very strong report. The risk, I think, is that it's going to be too much of a good thing because we're seeing an overheating of the labor market. And in particular, if you focus on the number of open positions relative to the number of unemployed workers, there's a gap of more than 5 million between those two numbers. And that sort of says labor demand is just way ahead of labor supply at this point.
When we look at labor force participation, are you encouraged by 3 straight months to the upside? And does that mean that wage pressures in the labor market, at least, are beginning to top out?
Well, I am encouraged that we've seen faster improvement in labor force participation, but we've seen even faster increases in labor demand. And so I think the gap is now significantly larger than it was a few months ago, despite that return into the workforce. As far as wages are concerned, the last 3 months were a little bit slower than the prior 3 or 6 months. So I think that is somewhat encouraging. There were probably some special factors in 2020 and 21 in the second half, including the extended unemployment benefits that have now gone away, but wages are still growing faster than what we can sustain in the long term at a 2% inflation rate, in my judgment. So I think it does underscore that, you know, the Federal Reserve needs to tighten monetary policy and slow things down here.
I don't want to dig into that a little bit more, but first, quickly, Jan, I mean, there are some areas of the labor market where unemployment rate is trending significantly higher than that national average. Disabilities is a great example. 8.8% is the unemployment rate there. I mean, are you going to start to see more of these groups come into or get hired within the workforce now that we are seeing this blistering pace and this need for jobs?
I would expect that, yes. I mean, typically what happens is that more disadvantaged groups are, lagged behind in terms of seeing their job opportunities improve. But then once you get to very tight levels, then the opportunity set there improves. And that's a great thing. That's a great thing. And seeing the job opportunities that we're now seeing, that's very good in the short term. The question is just, is it sustainable in an environment where the Fed wants ultimately to return to 2% inflation?
Yeah. So are we going to see a front-loaded Fed? Are we going to see bigger rate increases over the next couple of months? And how does that play out in terms of when you think about recession risk going into 2023? How does that play out?
Well, I think the next couple of meetings, I would expect 50 basis point hikes from the Fed. And, beyond the June meeting, we have a return to 25 basis point moves. But, frankly, it's very possible that these 50 basis point hikes are going to be extended. And, I think that's really going to depend on the data, the extent to which growth decelerates as we go through the year. We do think it's going to decelerate. And, the sooner we see a slowdown to more of a trend pace in both GDP growth and employment growth, the better the prospects, I think, that we'll avoid a recession. We don't have a recession as our baseline forecast for 2023. We've said, it's maybe as high as 1 in 3 or so. And I think that's a significant risk relative to the average risk that you see through the cycle. But I think it's still avoidable. But we do need to see a deceleration.